Hello, and welcome to this State Street video on the future of private markets investing for asset owners. I'm James Redgrave, Vice President of Global Thought Leadership at State Street. And I'm here with Eric Chung, Senior Managing Director for Global Alternatives, also at State Street. Eric, thanks for joining us.
Thank you for having me here, James.
So Eric, our fourth annual private market study this year shows asset owners and limited partners face a really wide range of operational challenges. And all of them really have data management at their core. So risk analysis and management, liquidity management, capital pacing and forecasting, they're the top three. Could you talk a little bit about the various ways in which data presents problems to the asset owner in particular?
Yeah, sure. Now, thanks once again for having me here. It's a very interesting topic, James. As you know, we've been on the road a lot. And overall, I think one thing that's really consistent when we talk about data is the fragmentation of data, first of all, right? It underpins private market. Very disparate and siloed information sources. And that is a common theme that we see across the world. Now, obviously, this causes a lot of difficulty in extracting data, trying to make sense of that data, cleaning it, and trying to reconcile the investment data that they get, which are more financial, and how do you associate that with the cash movements? That leads us to the next very important observation, which is private markets and its very nature is very unstructured, the data sources. Very different asset classes, from private equity, where you could be doing a company acquisition, to very illiquid infrastructure and real assets. And these data sets that they collect, not just financial information, but all the direct asset information that they collect, they're very, very different. And also the timing of the valuations next, right? Because each of these private market asset classes, they don't conform to a public market way of doing things where the pricing is readily available. So depending on which asset classes you're invested into, that timing varies. And as you get valuations or market value coming in, how do you stage this and how do you bring it all together in a very consistent format? So in fact, 60% of our global respondents, right, James, cite this as the most important challenge, and APAC respondents are slightly more worried at 73%. Obviously, on the investment side, capital pacing, liquidity profiling, this remains the greatest challenge facing asset owners. And about half of them we poll, they cite these two as the most important areas that need to get right? And really why? On liquidity management, you talk about private markets, they can be challenging as an investment that you make, may not lead to an immediate capital drawdown. But the asset owner has to make sure that the funds are there. So when the call happens, the funding needs to happen. And that leads us to a very important concept that you and I, we frequently hear, the opportunity cost increasingly. And when you commit to an investment, you need to earmark the cash and you need to fund these investments when the call happens. So the longer the wait, the longer you see on cash, the higher your opportunity cost of capital becomes. And that's the primary challenge, right? And that we're seeing. And if you look at public equities across what and typically how you invest, and private, you could be reserving cash, but they're invested. When a capital call happens and you have to sell those assets, you could be selling them at a loss. And lastly, quickly touch upon capital pacing, the ability to manage cash demands and to maximize that return on cash. They require that asset owners, they have more certainty around their returns profile. Two big issues here. The first thing is that capital calls are fundamentally very unpredictable. When a capital call happens, you have 7 to 10 days. And you have 7 to 10 days to effectively fund these investments, right, by cash basis. And these calls, they are tied to deal level, and each asset class is very different. The distributions are very irregular. So again, asset owners, they are hoping to recycle capital via distributions coming back. They often face the very huge question mark on when and how this distribution would be coming in. And this is very heavily influenced by macroeconomic conditions. So this, in total, is, I would say, the data challenges that asset owners are trying to solve for.
And I think a key response from LPs to these challenges has been technology investment. A little over 2/3 of them globally are increasing their expenditure on technology, according to our research. And in particular, they see the value of generative AI and large language models to help solve some of the manual data challenges they face that you've touched on there. So 40% of LPs globally are either already using this tech or are investing in specific use cases, and another 39% see the value and plan to start investing in this. So how does this tally with what you're seeing in the market?
So we are seeing Gen AI, LLM, definitely something that people are looking at. They are most deployed in areas of data ingestion today that we see, onboarding tasks, and very limited portfolio analytics. Now, mostly these use cases we see are around manual task automation, data aggregation, and to move data in a disparate format in a harmonized or what we call interpretation layer. So while Gen AI can automate manual tasks very well, like data extraction and reporting, I think often asset owners are now starting to realize that there is also, on the converse side of the equation, the cost of implementation. The customization and the governance that you then need often outweighs the immediate benefits, especially for LPs, the smaller ones that we talk to. What they're starting to realize is that this entire process is not just getting an LLM model and hoping that things will work. And this is increasingly becoming costly. So we're seeing LPs heavily invest in Gen AI pilots, trying to automate fund document parsing, for example. But then what we're seeing is that over a course of 6, 8, 12 months, these models struggle with inconsistent data format, a lot of nuances leading to a lot of interpretation error. And after months of tuning, compliance review, and they often find that the cost exceeded the manual effort it was meant to replace. Some of the asset owners that we're working with is actually leveraging the skill that we bring and the knowledge. And lastly, on that point, LPs must access the total cost of ownership in my mind. And this must include the total model training, the availability of knowledge, right, that you would need to train, the integration of those training models, the data privacy, and the ongoing oversight. The availability of data sets and repository, these are foundation. And you'll be surprised at how expensive these basic foundational tiers are going to cost, right? If you don't have the right subject matter expert. In summary, I would say Gen AI is not plug and play. It requires domain-specific tuning and robust governance, and this is very resource-heavy and intensive.
Yeah, that's interesting. And we do see from the data some interesting variations in application for these things as well. So by region and asset class, for example. In Asia Pacific, respondents seem to be particularly advanced in this area. 14% of them are already using Gen AI or LLM compared to just 8% of LPs globally. And there are sub-asset class nuances as well coming through quite strongly. Private credit spread data analysis was a popular focus for the technology, for example. So can you perhaps talk us through a few of the variations that you're seeing in your conversations with clients?
Indeed, APAC does lead in terms of tech spend. We're seeing 73% of APAC LPs increasing tech budgets and 14% already using Gen AI, but through varying degrees of success. And nearly that's double the global average. I would say that the first thing is on private credit as a thematic focus area for a lot of LPs today. As we all know, private credit has seen growth, exponential growth rather, over the last couple of years. And this is leading to more allocations going in. AI is now being used to extract and analyze data from complex loan documents. The ability to digitize this document is critical because bilateral loans, syndicated loans, and all type of credit instruments, they're really bespoke. So to improve the spread analysis and covenant tracking, a lot of human intervention is traditionally being used, right? So Gen AI is leading a lot of pilots in this space, and we're seeing very promising digitization rates, as we call it, in the primary documents that I cite. The second thing I would say is that in Asia Pacific, the demand for transparency by LPs, they're really pushing more towards, I wouldn't say real-time information like a public market, but definitely the push to more daily or weekly kind of reporting as compared to quarterly, semi-annual, and some annual valuation basis of illiquid assets. And the reason why they need more frequent analysis of their books is really the exposure. And so some of these performance metrics that we are seeing a lot of LP focus on are around any daily updates that they're getting, ESG insights that might be impacting their portfolio, especially if you move into more private space in real assets. And so this is just not a matter of spending money, but really the expectation that they need to use that data that they're getting today a lot better. So the push for transparency is driving a lot of granularity of those reporting standards. And this will then fundamentally reshape how GPs on the other side are going to respond to the increased level of granularity that LPs are looking for.
Thanks, Eric. Going back to your initial point about some of the data challenges that these organizations are facing, I think another interesting point from our survey is the extent to which this investment is being made on technology and operations to improve data, both regarding whole portfolios or buckets of holdings, as well as more granular information at the individual holding level. So how important are both of these different data areas to the asset owner in particular?
I would say very important. Traditionally, asset owner, they rely on their finance teams that are responsible for financial reporting and all aspects of the accounting book of record and for consolidation. Now, the front office teams typically in this environment, they tend to source, execute, and then monitor the life of the investment. And they used to be very disparate ends of the spectrum. So in short, there's a convergence there because the traditional world of financial accounting, they give you a view of what you are exposed to. But then if you look at the front office, when they look at operating metrics and they're looking at the asset level performance data, they're trying to explain why. Now, obviously, what you're exposed to and why the asset is moving in a particular manner is becoming very closely interrelated as they make better investment decisions around understanding the nature. So an example, in private equity, a fund may show very strong IRR, but unless you are talking EBITDA growth, understanding the customer churn of each of the portfolio company, you are not going to understand the sustainability of that return by just simply looking at a portfolio net asset value. So LPs are increasingly looking to integrate these KPIs, be it revenue, headcount, debt coverage, into dashboards. So the marrying of this kind of information to financial accounting records, it is what that is driving a lot of LP to invest heavily on a organizational data structure. So done right, the linking of this asset level information to accounting data, it creates a very powerful organizational data taxonomy that will give you predictive analytics capabilities. And I'll end by an example quickly. So in real estate, we're seeing a lot of use cases where a fund may report very stable NAV every quarter. However, if the tenant occupancy drops or the maintenance ratio spikes or the rental roll changes, a lot of this operating data flags this as very leading indicator of asset performance long before the financial books and records starts capturing any potential markdown. So this is what the power of predictive analytics can do in private market. And certainly this is an area of huge interest to LP looking to invest in this area.
So, Eric, looking ahead, what opportunities do you see emerging in private markets, particularly for asset owners?
I think great final question to that. I think the shift from public to private market is structural and no longer cyclical is the first thing that we need to note. And over 60% of investors plan to increase allocations to alternative, with 67% of our respondents this year citing private equity, credit, and infrastructure as the three most important allocation targets for them in the next 3 to 5 years. So definitely this reflects a very long-term rebalancing away from public markets that we should note. And the second thing that I think we are going to focus on quickly is the level of dry powder. Obviously, we've seen dry powder peak at about close to $1.8 trillion. And the number of deal activity that's now happening over the past 6 months have seen a lot of drawdowns from that dry powder, which are capital that is funded and not yet invested. And I think with this, we are also seeing a green shoot. Distributions are overtaking capital calls for the first time in the last 8 years. Now, LPs are now becoming more selective, and they're not just increasing exposure to private markets, they are trying to refine it. And I think the next few years, coupled with what we've spoken about, right, James, on the challenges of data, is a nice wrap to this. They're looking for thematic investment ideas in the next couple of years. They're looking for rotation from one region to another to extract yield within the private market space. And lastly, I think with data, they're actually trying to focus on what is the cross-asset risk profile of all the private market investments and the opportunity costs that we talked about earlier on from public to private. So some of the key takeaways here: private credit continues to lead due to its inflation hedging properties and a lot of interest still from investors putting capital to work. And we believe that there is still room for this segment to grow as the addressable universe from an investment point of view is large. Private equity, very foundational. It is the largest segment within private market, but investors are rotating strategically, as I mentioned earlier on, right, James? So how do I move from North America to Europe to extract more value? And how do I tap the fast-growing region of Asia Pacific and get detailed investment theses formed up? Lastly, infrastructure, real assets. These are very long duration assets that a lot of institutional investors will continue to favor. The long duration just means that they are able to lock in a stable return profile over a longer period of time. And that's attracting new classes of client type like insurance houses coming in. And lastly, hedge funds are back in focus. Near-term, medium-term macroeconomic shocks and policy uncertainty. We're seeing a lot of investors, more than half of them, they're now increasing their allocations to better manage volatility with hedge-like kind of liquid and private strategies. So all in all, I think these are some of the trends that I will summarize for this session.
Eric, once again, thanks so much for joining me. It's always a pleasure to discuss this topic with you, and I think you've given our viewers some really interesting and valuable insights here.
Yeah, no, thank you, James, for having me here today, and really excited. And I look forward to the next edition of our private market survey to see what those findings might look like.
Well, you heard it, folks. There'll be another one next year. Thank you for watching.